All right, let's talk about one of the most powerful numbers in the entire startup universe, annual recurring revenue, or ARR. If your business is built on subscriptions, this isn't just another metric. Honestly, it's the very heartbeat of your company. So, think about it. You've got a fantastic product. People are signing up, but how do you really prove that you're growing? Not just a flash in the pan, but real sustainable growth. How do you show that to your team, to yourself, and maybe most importantly, to investors? Well, it all comes down to telling the right story with one key number. So here's our game plan for today. We're going to kick things off with why ARR is basically a magic metric. Then we'll nail down exactly what it is. I'll show you how to calculate it, how to use it to track your growth, and finally, we'll get real about its biggest strengths and its hidden weaknesses. Let's dive in. Okay, first things first. Why all the hype around this one number? What makes it such a total game changer? It's simple, really. ARR has this incredible ability to cut through all the noise and tell a really powerful, really clear story about where your business is headed. It all boils down to one single, beautiful word: predictability. Look, getting a big one-time sale is awesome, but you can't build a future on it. ARR, on the other hand, is the revenue you can reasonably count on coming in over the next 12 months. And that predictability, that is absolute gold, especially to investors, because it signals a stable, scalable business. So we know it's all about being predictable. But let's get a really precise definition. The true power of this metric is in the details, so what actually gets to count as annual recurring revenue? At its very core, ARR is just the value of all your recurring subscriptions, kind of smoothed out over a full year. And if you remember anything from this part, burn these two words into your brain: predictable and annually. This is the income you can genuinely, reliably count on year in and year out. And this is such a critical distinction to make. On one side, you've got your foundation. That's your recurring revenue from subscriptions. But on the other side, you've got one-time revenue. Think things like setup fees or maybe a special consulting project. Now, that cash is great, don't get me wrong, but because you can't count on it happening again, it absolutely has to stay out of your ARR calculation.
All right, time to roll up our sleeves and get practical. In this section, we're going to break down exactly how you figure out your own ARR. And trust me, the math is not nearly as scary as you might think.
You know, I just love this quote from our source material at Upgrowth because it frames ARRs so perfectly. It's not just some number you report on a spreadsheet. It's a strategic tool. It gives you the context you need to make way smarter decisions about where your company's going.
Okay, let's break this down. Your ARR basically grows in two ways. First, you add up all the revenue from brand new customers. That's your acquisition engine firing on all cylinders. Then, and this is so important, you add revenue from your existing customers who upgraded or bought more from you. We call that expansion revenue, and it's a huge sign that people love your product. But of course, ARR can also shrink, so the last step is to subtract any revenue you lost from customers who canceled or downgraded. That's what's known as churn. So here's what that formula looks like in action. It's simply the money you gained from new business and upgrades, minus the money you lost from churn. That final number? That's your ARR. Just think of it as the net result of all your subscription activity for the year. Now, calculating your ARR once is useful. It gives you a snapshot in time. But the real magic happens when you start tracking it over time. This is how you measure your startup's true velocity, its actual speed of growth. A single ARR number is just a photo, but tracking how that number changes month over month or year over year, that's the movie. And your ARR growth rate is arguably the single most important metric for a subscription business because it answers that one simple question: how fast are we really growing? And a simple chart like this just says it all, doesn't it? That jump from last year to this year, that is the very picture of momentum. This is the kind of slide that gets your team fired up. It's the slide that makes investors lean in a little closer. It's a story of growth that everybody understands instantly. So it's pretty clear that ARR is a powerhouse metric. But, and this is a big but, it's not a silver bullet. To use it wisely, you have to understand both what it can do for you and, just as importantly, what it can't tell you. When you use it right, ARR is like your strategic command center. It helps you forecast the future, it lets you see if your sales and marketing efforts are actually paying off, and it helps you make smarter bets on where to invest your time and money. And because it's so predictive, it becomes a cornerstone of your company's valuation. But you have to be careful. ARR completely ignores those one-time fees, which can be a big source of cash. It also doesn't tell you when the cash is actually hitting your bank account. And a growing ARR can sometimes hide a really serious problem like high customer churn. If you're just replacing lost customers to stand still, you're on a treadmill. It always needs context. So at the end of the day, ARR is so much more than just a metric. It's a narrative. It's the story of your company's journey. It reflects your wins, your losses, and your momentum. So the question I want to leave you with is this. Now that you understand it, what story are you going to make your ARR tell next?